Hey everyone. Today's topic, we're going to discuss global insurance and the ever changing world of mortality expectations. There's been some incredibly cool research that's gone out in recent weeks. And yes, I fully recognize that you have no shortage of things keeping you up at night, from a looming recession to stubborn inflation, and no shortage of massive geopolitical events. I do think that it's worth giving some time to thinking about evolving mortality picture and the implications to your business as an insurer. And if you're an underwriter of life, annuity, and healthcare, I think the topic is very obvious to you. But for those that are P&C and non-life and non-health, I think it still has massive implications on the investment asset side of your balance sheet. So, for example, the Swiss Re Institute just published a really interesting piece that took a look at historical mortality developments in major economies and then compared them to the trends we're seeing today and where we're going in the future. The first thing they called out was that since 2010, we've seen a relative flat line of mortality improvement on a global basis. Now, this isn't unheard of. And if you think about recent history, it makes sense because you'd expect mortality improvements to start to slow once most of the population stopped smoking and how you had large scale improvements in the treatment of cardiovascular disease. But what is unique is that the slow and the stagnation of these improvements has now been much longer than any period they had seen in the 20th century. And they're wondering why that is. Also of note has been the considerable amount of research that we've seen done between those with high incomes and those with low incomes. Beyond that, the US itself in particular finds themselves in a strange situation of being a very large advancing economy, but actually having mortality degradation, which they're attributing in part to things like unequal access to healthcare, obesity, the opioid epidemic, and the increase in violent crime rates. Finally, the lower the socioeconomic cohort, the worse that section has in terms of mortality experience. In fact, it's been proven over time that portions of the population have a tendency to experience outsized decreases in mortality in the event of major recessions and economic collapse. The National Library of Medicine actually did a study and found that the top 1% in terms of wealth has a tendency to outlive the bottom 1% by nearly 15 years. And that's a gap that has continued to grow considerably since the 1980s. So the research notes three major factors that insurers should pay attention to when assessing mortality changes on their business. The first is this idea of cyclicality, which I just mentioned. This operates in waves. So you need to decide, where are we in that cycle between improvement, between plateauing, and in some cases, degradation. The second is divergence. So I mentioned the US was on a proverbial island when it comes to mortality experience. Will the rest of the world follow suit where we start seeing declines globally? Or will the US have a correcting mechanism which gets them more in line with the rest of the world in terms of seeing some gradual mortality trend improvement? And finally, it's using insured population dynamics as a way to forecast what will happen. This used to be a fairly reliable predictor of what was to come, but now there's been a lot more questions about how useful of a forward or leading indicator that actually will be. So many experts have said a few major themes will be the key to this next wave of mortality trend improvement. The first is better diagnostics around cancer treatment. Second, lifestyle improvements and behavioral changes. This will help, in part, contribute to better outcomes for cardiovascular disease above and beyond where we are today. And finally, it's the advancement of treatment on diseases associated with aging, such as that of Alzheimer's. In a piece by the Lancet Medical Journal, they actually attributed 40% of aging to things that they deemed to be modifiable behaviors. And this included smoking, alcoholism, physical activity, and obesity, among others. Now, while they did have 60% as unattributed, 40% is still a substantial component of things that we could be actively working on, or in your case, investing in or underwriting products for, that could contribute to longer duration mortalities over time. So, what does this have to do with your business holistically and your portfolio specifically? Well, first and foremost, I want you to ask yourselves, how is your company thinking about mortality today? Are you using facts that are anchored to history, or are you building in some of the mortality trends that we've discussed so far? Are you considering things both from a cohort and population location perspective, or are you even considering things like socioeconomic status when you're thinking about reserving for legacy products, but also for underwriting or creating new products? And from an investment perspective, have you considered using thematic approaches to address some of these themes that we've touched on today? These are things that will be applicable both in developed economies, but maybe even more so in emerging economies when you think about investing in social inclusion or access to healthcare. And second, are you using private asset markets to target some of these innovations to act as a business hedge of sorts? Are you investing in things like insurtech or healthcare innovation as a way that if your underwriting experiences negative impacts from some of these trends playing out, that maybe you're going to see a benefit from that, not only on the business side, but also in your portfolio returns by making some of these investments in companies at the more early stage part of their life cycle. And so my view is making these longer term themes part of actionable things that you can do today as part of your business strategy. It should be a best practice for insurers everywhere. And through this series, we'll look to find small incremental ways you can make changes to your business to consider some of these larger looming risks in the future. Thanks.